Hello, everyone. All right, so we're going to solve problem A-47 from our cost accounting book, 17th edition. Here we have the information, okay? This is variance analysis, and this problem will include all costs, materials, labor, variable overhead, and fixed overhead. So we're given actual results, we're given budgeted numbers, and here we have the requirements. As you can see, the first two will be material variances. The second two will be labor variances. Then we have two fixed and then variable. Okay, variable over under allocated. Well, it's total variances. So for that, we need the variable chart. Okay, because they want the total over or under allocation. So we need to know that's a combination of fixed and variable overhead. Okay, so we're going to start with materials. Okay. But first, let's read. We want to remember step number one, identify what's your output and what is your input. So in this case, we are the Manzano company. We're starting business and we are going to use standard costing. This is variance analysis. It's for standard costing. Okay. And we are making backpacks. So the backpacks is our outputs. So we're going to work with materials. Let's identify what is the materials, what is the input. It looks like some sort of fabric because it's in yards of fabric right here, okay? Yard fabric. And this is the amount of fabric per backpack. So input per output, okay? That should tell us. We're going to start with output. Then we're going to multiply the input required for a unit of output, which we're being told right here, 1.5, and that is the budgeted number. Then the total input times the rate, that will give us the total cost. Again, so how many backpacks, how many yards of fabric per backpack, that will tell us the total number of yards times the rate per yard. Okay, in this case, we'll say per yard. Okay, that will give us the total cost. So we're going to have, let's cut this here. We're going to have actual numbers. We're going to have that middle column, which is the flexible input. Okay. And we're going to have the flexible budget, which is the flexible output. Okay. And we could have, let's make this a tiny bit smaller. Okay. We could have another column right here. Okay. We could have the static. So we know where the numbers are coming from. Okay. All right. So let's fill in this chart with the materials information. First of all, output, actual results, actual output, 180,000 backpacks. We wanted to make 160. So that goes in the static budget. Okay. Number of output backpacks. The selling price is irrelevant to our analysis. What we're looking for is material information. 1.5 is the fabric per backpack. Input per output. That's in the static. 1.5. Okay. Price per yard, fabric. So the rate per yard is 2. That's the budgeted number. Okay. And then direct materials of fabric used in yards. Okay, we don't know if the amount purchased equals the amount used. So let's make that assumption for now. Okay, let's assume that usage equals purchases, okay, for materials. We're not being told anything that would indicate otherwise. Okay, so we're going to use the 280,000 yards that were actually used. Okay. Variable direct material cost. Okay, so this is not variable overhead. Okay, remember material is always a variable cost. So that's why it says variable here. So don't be thrown off by the word variable. It's not variable overhead, it's still materials. Okay, 574. Okay. So we have all the numbers we need. Everything else is labor related or overhead, so we don't need it for the price variance or efficiency variance. All right, so let's build a flexible budget. Okay, remember we're gonna bring in the actual from the actual column, okay? So we're going to use 180. And then we're going to bring in, what is the amount allowed, okay, per unit? 1.5. So we're supposed to use a yard and a half to make 180,000 backpacks. So what is the total number of yards that we need for production? 270,000. Okay. And then the two also will move all the way to all the flexible budgets. Okay. So here we go. 2. So what is the total cost that we were supposed to pay for 180,000 backpacks? Well, the 270,000 yards times the $2 per unit. Okay, that's 540. So we can start with the flexible budget variance. That will be the difference between the actual and the flexible. So it's 34,000, and because we paid more than what we budgeted, this is going to be an unfavorable variance. Okay. All right, now let's answer number 1 and 2. So again, number 1, what is the efficiency variance? Number 2, what is the price variance? Okay, so let's build the M. Okay, that's going to tell us both variances. We're going to move in the 280. And I think I have an extra 0 there. Yep. And we are going to move in the 2, right, from the static. So we multiply one times the other. We get 560. So what is this telling us? If we're going to look at the efficiency variance, we were supposed to use 270,000 yards. We used 280, so we know right away that we're not being efficient. This is going to be an unfavorable variance, and then we see it down here, okay? The result is that we're 20,000 over in our actual numbers compared to our estimate. So it's going to be unfavorable. Okay. And then let's see how much we paid per unit, even though we can see that we were not good with managing our pricing. Yeah, we paid 5 cents more. Okay, so that's why we have an unfavorable price variance. Unfavorable. So, yep, 14 plus 20, 34. Okay, remember, this is the price variance and this is the efficiency variance. Okay, and this is your flexible budget variance. Now I have to charge my computer. Just give me 1 sec. All right. So now we're going to move on to the labor variances. What labor variances is the problem asking for? Efficiency variance and price variance. Okay, so let's build the labor chart. Same chart. So I'm just going to copy and paste. But instead of using the input, the yards as input, now the input, it's the labor hours worked. That's the resource that we're using to make the output, okay, which is the backpacks. How many labor hours were worked? Now we're in labor. So the first line, it will continue the same. It's the same problem, so we can copy and paste. Same line. Okay. All right. Let's get the information related to labor. Direct manufacturing labor hours per backpack. You're supposed to take half hour to make 1 backpack. Okay. And then we are paying $12 an hour. Okay, let's put a $sign so we know this is great. And what else? We used 100,000 hours. Okay. And the actual labor cost, 1,260,000. Okay. Okay. All right, that's it. This is fixed overhead and this is variable overhead. So we can ignore the rest, but we have everything we need to solve for variances. So again, let's bring this in once. And let's bring the 12 in all the way to the flexible input. And we're going to bring this 100 over once to the flexible input. This is how we're going to move the numbers inwards. Once we have the actual, we have the static, we start moving the numbers in. We're going to have 100,000 hours times 12. All right, we have everything we need. So let's get the number of hours allowed for production of 180 backpacks, 90,000 hours, which will cost us 1,080,000. So how did we do? Well, we paid more. So we can see that it's going to be unfavorable. Okay, so non-favorable efficiency variance right here. Unfavorable, not efficiency, I'm sorry, flexible budget variance. All right, and then we have, yeah, right here, let's compute it. 100,000 times 12, 1,000,002. Another unfavorable variance with pricing. How much did we actually pay our workers? Let's see. Looks like $12.60 instead of $12. So we paid a little more. So we have an unfavorable variance. This is the price variance. Okay. And efficiency variance, we used 10,000 hours more than what we were supposed to use. So again, another unfavorable result. Okay. Unfavorable efficiency variance. Okay. All right. Let's move on to the variable. Yes, write this down. Variable overhead. And here's our information. So it's the same chart. Variable overhead. We're going to have the output, cost, all these rows. What's the driver here? Okay. Well, let's see. So the allocation base is what? Labor hours. Okay, so Manzano chose direct manufacturing labor hours as the allocation base. So all our overhead will be based on labor hours. Guess what? That makes our life a lot easier because we already have the labor hours. We can copy and paste. We're making 180 backpacks. When we took 100,000, we used 100,000 hours. We should have had used 90,000 hours instead. Let's copy this as well. We have the same information, it's the same driver. All we're changing now is the rate, okay? We're not solving for any variances on the variable chart, but since we're at it, let's do it. We're gonna need the over under. And remember, this is also allocated when we're doing overhead, okay? So what is the rate? Well, let's figure that one out. 550 right here is your budgeted number. So with the 550, we can figure out the rate. Okay, so let's enlarge this a little. We were supposed to take 80,000 hours for production. Okay, and the rate in that case will be the rate is cost over drive, 6.88. So this is our budgeted rate. Let's bring the rate all the way in to the M. 6.88, and it's also a dollar sign. Okay, 6.88, and let's compute. So we have 90,000 times 6.88. Okay, this is a larger number. Okay, we do not want the double zero there. It's 4. And remove this. There we go. Okay, in here, again, 100,000 times 6.88. Another one that we need to format. There we go. Okay. And this number is given 535. So we can put it here. 535. Finally, a favorable variance. But anyway, we're not looking for variances. I'm gonna solve for them anyway. So the over under allocation is the same as the flexible budget variance. And in this case, we have a favorable or over allocation. Okay. So is it favorable? It's also over allocated. Okay. All right, so the spending variance, remember here's what we call spending. It's also favorable. Okay, we have a spending variance of 153, which is favorable. And the efficiency variance is not favorable because we used 10,000 hours more than estimated. So now we have a difference of 68. Okay, so this is unfavorable. So we do 153 minus 68.8, we get 84.2. The question is asking, what is the total, right, over under allocation for the year? So we have the variable down. Now we're going to make the static. Okay, so the static, the fixed. And the fixed, remember, it's a little bit more complex. It's a little change here. All these other are variable costs. Now we're going to go into fixed costs, fixed overhead. We do not have a middle flexible input. Okay, remember, we have an actual number that is usually given to you. Then we have the flexible budget, which is same as static. Okay, then we're going to have the allocated. Finally, the static. Okay, so we can put the static here. We're going to copy static into flex. All right. So same driver. Just use the numbers we have here. We really don't need we don't need the number of units. When it comes to fixed cost, I'm not going to copy and paste. I'm just going to make it again. Okay, we just take the actual number given to us. It's a fixed number. It's 875. Is it that or not? So let's put a dollar sign. 875. And then we're given 800,000, which is the static that we're going to be copying into the flexible. Same, we cannot flex fixed cost. Remember, we're not flexing fixed cost. It takes the same form as the static, okay? We are making, we were budgeting on making 160,000 backpacks, taking half hour. So this should be 80. Okay. That tells us that the rate is $10 an hour. So I'm going to move the rate over here. And by the way, this I'm going to copy completely and transfer this over here, same as the static. Okay, but the allocated behaves the same way it always has. So you can see here, allocated 180 is the input, the output, sorry. Input per output is a half hour. So this is 90. And this will be 900,000. Now we can get the variances. Our first variance, spending variance. Unfavorable. We spent 75,000 more than estimated. In the next variance, production volume variance. Oh, well, this turns out much better than expected because we have capacity to use 80,000 hours. However, somehow we pulled it off and we used 90. We were productive. We're paying the same rate. We're still paying, well, we paid 875 in this case, but we would be paying one flat fee. Okay, this didn't change because we made more units. It changed for other reasons. Okay, the number of units made is irrelevant to how much we're actually paying. Okay, but the fact that we were able to use more hours, that's a good outcome. Okay, we were productive. We have 100,000 production volume variance. That is favorable. Favorable. We were productive. So we have an over under allocation. What is this? Our books show 900,000 when we actually spent 875. We have an over. Okay, we over allocated by 25,000. Okay, over allocated. So the answer, this will be answer to E and F. Okay, so this is spending. This one is production volume variance. And let's sum it up. So we have variable overhead, fixed overhead. Variable overhead turned out to be 84,200 over allocated. Fixed overhead turned out to be 25,000 over allocated. So total overhead was these two, 109,000 over allocated. All right, and that's the answer for G. Okay, guys.